Hello, everyone. Thank you for joining today's webinar, Nuts and Bolts of Taking the Opportunity Zone Plunge. Today's program will be presented by Philip Karter from Chamberlain Hrdlicka and Withum's Brian Lovett and Tom Fleming. Before we begin, I have a few housekeeping notes. Materials for today's presentation can be found in the toolbar located on the right of your screen. Also, at the bottom of the toolbar, you will see a chat box. All questions pertaining to the webinar can be answered at the end. We will do our best to address them. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. With that, I'm going to turn it over to the team.
Great. Thank you, Allison. So this is Phil Karter. Hello, everyone. Thanks for joining us. And I don't know how many of you have attended Opportunity Zone seminars. There has certainly been a plethora of them. The goal today was to kind of dig a little deeper. I guess it's, the advanced class to get into some of the finer points of Opportunity Zones, although we'll do a very quick refresher on the basic rules before plunging in. We wanted to provide some practical comments and tips with regard to folks who are already in these types of investments and want to know what do we do now, as well as for people who are contemplating making the decision to finally take the plunge. So if you want to go to the next slide. Yeah, it's interesting because I opened up Sunday's New York Times, and lo and behold, the top story in the upper right corner is all about opportunity zones and how people are taking advantage of this, what is really a tremendous tax advantage. And just a little quick history, if you all remember how the Tax Cuts and Jobs Act was cobbled together at the very end of 2017, some of you may remember the congressman holding up a piece of paper with some chicken scratch scrawlings on it. There was not a lot of commentary that was circulated, as is typical for tax legislation. And as a consequence of that, when the Tax Act passed, there was very little that was noticed about this provision. It was kind of stuck in there, and it wasn't until the beginning of 2018, when the law became effective, January 1, that people even really noticed about this provision and started to decipher it and what it meant. And it's interesting because the program started in 18, but there was very little activity right off the bat. Well, there's a couple of reasons for that. Number one is that the opportunity zones that had to be designated by each state were not even released yet. So one couldn't know if one wanted to acquire an interest in such a property, where that property would be located. And they started to dribble out in March, April, May. I think by the time around May, those had been released and people started focusing on particular properties. But at that point, all we had was the statute, and we had absolutely zero guidance. And one of the things you learn from being in this space is that there are tremendous complexities if you want to do it right and get the benefits that everyone is trying to achieve. So we all waited patiently until October, when the IRS released about 150 pages of regulations. And they were good and they were helpful and they answered a lot of questions, but they didn't answer everything. And then, just to try to make a long story short, they were supposed to release a second round of regulations at the end of the year, and we had the government shutdown that lasted into almost February. And as a consequence, we didn't get a second set of regulations until April. And those answered more questions. I would say not all. There's supposed to be yet one more round, but a lot of them, and enough to make people feel comfortable if they hadn't already taken the plunge, then to start to run in there. So the answer is yes, it's a very big deal. Yes, people who started to dip their toes in the water are starting to take the plunge, and some people have taken the plunge. And the goal today is to try to help you navigate through that if you have clients or if you're a participant yourself, as to how to do it right, and to make sure you're getting the benefits that you hope to get. So I'm going to turn it over to Brian, who's going to just kind of do a very quick refresher of the high-end aspects of this. Brian?
Thanks, Phil. Yeah, as Phil mentioned, I think today we're going to try to take a little bit of a deeper dive, but before we did, we wanted to just do a quick refresher on the overall tax advantages of an investment in a qualified opportunity zone. What do you get out of this? Why is it such a big deal? So as the slide mentions, there are really three tax advantages that you get when you invest your capital gains into a qualified opportunity fund. So the first benefit you see here is original temporary deferral of that gain. So you sell stock in 2019, generally speaking, you have to pay tax on that stock with your 2019 tax return. If within the requisite time periods, and we'll talk about that later, you reinvest that gain into a qualified opportunity fund, you can defer payment of that tax until the date you sell the investment or 12/31/2026, whichever comes sooner. So we'll talk about the third benefit, which requires a much longer holding period. So if you invest into this opportunity zone fund and you hold that investment on December 31st, 2026, now you have what I call judgment day. That's the day you have to pay the tax on that, say, 2019 sale of stock, the gain on that sale of stock. Any capital gains, we're going to retain their character. So we're going to talk later about you could do long-term gains or short-term gains. They do have to be capital gains under the Act, and they'll retain character. So you can't buy stock in late 18, sell it now, realize a short-term capital gain, invest that into an opportunity fund, and via this temporary deferral, get to 2026 and say, well, now that gain would be long-term gain. If it was short-term gain when you sold the asset and invested into the opportunity fund, it remains short-term gain in 2026 when it comes time to pay the government. So this isn't a play to make your short-term gains long-term. The gain will retain character. It does apply to 1231 gains. There's a little bit of controversy with respect to 1231 gains, and for those who know, 1231 gains are from the sale of assets used in a trade or business. And just by operation of the way 1231 works, you really don't know till the end of the year because of some special netting rules for Section 1231 gains. You really don't know it till the end of the year if you even have a capital gain on a 1231 transaction. If you have 1231 gains and losses throughout the course of the year, you have to net those against each other. So the regs that were issued in April require you to wait till the end of the year to even determine if you have a 1231 gain, which is a little bit controversial currently in the industry. And again, if you have any depreciation recapture or any 751 hot assets in a partnership context, those gains aren't going to qualify because they're not treated as capital gains. They're treated as ordinary income. So depreciation recapture and some of your 751 hot assets reclassify a capital gain to ordinary income. Once it's reclassified to ordinary income, it's no longer eligible for this temporary deferral. So the first benefit, that's the temporary deferral until 2026. The second benefit is a potential for permanent exclusion up to 15% of the amount initially invested. So we're going to talk later, your initial basis starts at 0. You have the opportunity based on your holding period, and you can see it here on the slide. At 5 years, you pick up 10% basis that you'll never pay tax on. At 7 years, you pick up another 5% for a total of 15%. So if you invest in 2019 and 2024, 10% of that deferred amount is now going to be permanently excluded from tax. You're not going to pay on it. If you invest and you have that 7-year, you hit that 7-year anniversary, another 5% is now permanently deferred, permanently excluded from tax. It's not going to be part of your payment when judgment day comes at the end of 2026. So you have to keep those 5- and 7-year hurdles in mind. And then the third benefit, which is the benefit everybody heard about with opportunity zones, they tend to miss the first two and think that if I just sell my stock today and invest and hold for 10 years, I never have to pay tax. And that's not the way the program works. If you hold that investment for 10 years, then any appreciation over and above the amount originally invested. So if you sold Apple stock and recognized a gain of $500,000 and you invested that $500,000 into an opportunity fund, and then after 11 years of investment in the opportunity fund, you're able to sell that investment for $1 million, it's not the whole million, it's the $500,000 from what you invested to what the appreciation was after 10 years that is then permanently excluded from tax. Now the other 500 you've dealt with via either those 5 and 10% basis adjustments and judgment day on December 31st of 2026, but that post-investment appreciation is now permanently excluded from tax. And depending on some of the numbers, you hear of $20 and $30 million investments in opportunity funds. If those investments grow to $50, $60, $70 million after 10 years, all of that appreciation is going to be excluded from federal income tax, and as we're going to talk about later, from some state income tax as well, depending on conformity. So at this point, I'm going to turn it back.
If I can just
go ahead, jump in.
I was just going to jump in and make one point on the 12/31/26 judgment day. The statute actually provides that the recognition of gain on your original investment, so in our example, our Apple stock, is defined as the lesser of the deferred gain. So let's assume you've held it for 7 years. You've got 85% of that gain is going to be taxable. But it's important to note that it's either the lesser of that gain or the fair market value of the investment at that time. So let's just assume hypothetically that we all hope that we make an investment and it's going to go nothing but up. But when you think about it, if you're going to hold it for the 10 years, even better would be a slight dip in the value of that property on December 31st, 2026. Why? Because if the basis has declined, if the fair market value of that property has declined, it's going to reduce the gain you have on your original qualifying investment, your stock investment, for example. So all I would say to you all is that come 2026, if it's a close call and there's a question about what the valuation of that property is, even if you have no intention to sell it, what you should do is you should go out and get an appraisal of that property. And if by some chance it's declined in value effectively below what you paid to acquire it at the beginning, then when you fill out your tax returns and report the deferred gain from the original investment, it's going to be reduced by that amount. So that's just something to keep in mind. Okay, I think we can go to the next slide.
I think the next slide's a polling question. So,
true or false, in order for permanent exclusion from tax on all appreciation of a QOF investment, the QOF investment must be held until December 31st, 2026. So we have about 56% that have voted. Get your votes in. We're going to close up in a minute. Almost there at 80%. And we're going to cut it off in just 1 second. Alrighty,
Okay.
It looks like 61% voted true.
Brian, you want to respond to that question?
you can go ahead with it.
Okay, I lost my PowerPoint. There it is. Okay. Yeah, I mean, the answer is false, actually. I forgot what the question was, but basically you have to hold for 10 years from the time you make the investment. So if you make it today, September 5th, 2019, you're going to only get that exclusion of the appreciated gain if you sell on or after September 5th, 2029. Remember, the 2026 date is the deadline for reporting the original gain on the unrelated investment that you put into the Qualified Opportunity Fund, okay?
Right.
So those who answered false, you had the correct answer.
Correct. False was the
All right.
correct.
Yeah, okay. So Tom and I were talking today, and it's a little bit of a paradox and a byproduct of the fact that this was all cobbled together very quickly, as I talked about at the beginning. But you'll notice that you have to hold the investment at least 7 years to get that full 15%, which means that we're now in the 2019, and it only applies up into that deadline of 12/31/2026. So if you don't make your investment this year, at least unless the legislation is amended, you're going to lose that extra 5%, because no matter what you do, by the end of 26, you'll have held it less than 7 years. So anyone who's contemplating, do I do it now? Do I do it next year? I've identified a property. You want to try to get that extra 5% reduction. And similarly, if you were to do it in 2021, after that, then you'll be under the 5-year period. Now, it doesn't mean that you lose the deferral benefit. Let's just say I make my investment on January 1, 2022. I'm not going to hold that by the end of 26 for 5 years, so I'm not going to get the 10%. I'm not going to get the 15%. I still get a deferral on the original gain, which would now be 100% reportable on my 2026 tax return. And if I hold it 10 years, I will still get the benefits of the appreciation. So as Brian referred to at the outset, it's the first of those three benefits that's on the clock. And because this thing was a little slow in going, it's a little bit ironic that we're now toward the tail end of 2019, things are cranking up, and under the current legislation, you basically have 4 months to make that investment this year to get the maximum benefit possible under the law.
Okay. Yeah, I know we're seeing that a lot with people rushing to try to get done by the end of the year. And, I try to counsel people 5% is a nice piece. And depending on the size of your investment, it's definitely not, a negligible benefit here. But at the risk of rushing to a deal that may not be the right deal, I think you really need to sit back and make sure that you're making the right deal and not doing it for this 5% piece, because, it may cost you more than the 5% savings for doing the bad deal or rushing into the deal and not doing it properly.
So let me pose a hypothetical question to the group, to the panel. So let's assume that you want to get a deal done. You've got the qualified opportunity funds you want to put in to, you've got the investment funds you want to put into a QOF. They haven't identified the property yet. What do? Can you put the funds into let's say an LLC or a partnership that elects to be treated as a QOF and just let them sit there for a while? And we're going to get into this in a little more depth later. But there may be many people who have all the right intentions and they've got a fund that they're going to put together or participate in, and the fund has yet to find the perfect property to invest in.
Right.
Anyone want to throw their 2 cents on that?
I mean, I think as we'll talk about, go ahead, Tom. Okay. I think as we'll talk about later that the regs provide some safe harbor that I think you can take advantage of in order to defer some of this time. Because again, the 5% is on your investment in the QOF. You may be able to take some time once the funds are inside the QOF to be able to deploy them into the proper assets.
Yeah, I mean, the way I look at it, guys, is that you put the money in, you may not have the property identified, and let's say in the worst case scenario, you never identify the property in sufficient time. And by the way, there are ways to maximize the amount of time that you can hold that money in the QOF or subsidiary entity. It comes out or it gets redistributed out. No harm done. As a matter of fact, when you file your 2019 tax return, you just report it as you ordinarily would. So I wouldn't preclude the possibility, if the intentions are there and you're just looking for the right property but you haven't found it yet, to take advantage of that, with the understanding that you will eventually have to identify that property within the requisite time frame and get it up and running. So it's one of those no harm, no foul, other than whatever expenses are associated with putting money into a partnership or a corporation to have it ready there to be deployed. Because you're not going to file your QOF election until the following year anyway, when you make the return. So if you, for some reason or another, never get it going, you just don't file that election. Okay.
I think we're good on this one here.
We'll go to the next slide. Okay, yeah, just very quickly, the structure of these arrangements is that they require that the qualified opportunity fund be a corporation or a partnership. Now, there may be instances where a corporation is desirable, especially for an operating business, let's say. If you want to run a qualified opportunity zone business, they now have 21% tax rate, which has been greatly reduced. But mostly in real estate, what you're going to see are partnerships or LLCs. Now, I should note that partnership by definition requires more than one partner. So a corporation can actually be run as a QOF with an individual owner, whereas a partnership or LLC cannot. Okay, next slide. So here's the thing, and it gets a little complicated, but the essence of a qualified opportunity fund is that it has to own what's known as qualified opportunity zone property. What is that? Well, you can see at the bottom of the slide, it's one of three things. It has to own stock, it has to own a partnership interest, or it has to own business property. Now, let's suppose we don't have the business property up and running yet. So what we typically do when these are structured is we almost unilaterally and exclusively prepare them with a subsidiary entity, typically a partnership. So, and that meets the definition of the qualified opportunity zone business property. So effectively, investor puts money into the QOF. QOF forms a subsidiary LLC that it owns with another partner, typically the manager of the project. And the money, then you've got a tremendous additional amount of flexibility, particularly with regard to the use of working capital that's sitting in cash while the project is waiting to get underway. So you can expect that in all instances, if you structure a qualified opportunity fund, either as a partnership or as a corporation, you're almost always going to set it up with a subsidiary business that meets the definition and provides much greater flexibility in terms of the timing of when funds have to be expended. Okay,
yeah, and
next slide.
That subsidiary business, that indirect method, also gives you a little bit of flexibility with respect to your asset mix as well, right? So, you know, how you deploy that capital once it's down in that subsidiary business, that you have a little bit more of a, you know, you have to test it as a qualified opportunity zone business, which is a little bit of an easier test than that 90% asset test.
That's absolutely right.
Phil,
it does give you more flexibility and the test is less stringent.
Phil, is it also worth discussing whether a qualified opportunity fund can be a subsidiary, or does it always have to be a parent?
So you can't have multiple QOFs. I mean, everyone invests in a single QOF. That is the parent entity, and that is the entity that has to own the QOZ business. So individual investors or funds that are investing, they themselves are not the qualified opportunity fund. They are putting it into a qualified opportunity fund. Now, I just will say that the law allows you to take an existing entity and elect to have that treated as a QOF. You don't have to form a new entity. Most people do for a variety of reasons. But if you've got if I've got a group of people in a partnership already and I want to start a new QOF project, I can take that entity and treat that as the QOF, and when I file my return, elect to have that treated as the QOF. But it does have to be the top entity, if you will.
Yeah, and I mean, I think you could do multiple in a brother-sister context, right? Family Office A and Family Office B each want to go joint venture a particular opportunity zone business, maybe formed as a partnership. They can each have their own QOF that invests in that, so long as it all passes the tests. I think it becomes, you can't have QOFs that are tiered up and down, right?
Up and down, right.
Because your upper tier qualified opportunity fund investing in a lower tier opportunity fund wouldn't have any qualified opportunity zone stock, partnership interest, or business property, and it would therefore fail the test.
Yeah, I mean, it sounds more complicated than it is, but if you look at that diagram on the last page, it's really quite simple. Opportunity fund at the top owns QOZ business, either a corporation or a partnership, and that QOZ business owns the actual project.
Right. Yep. Agreed.
Yeah, this is the structure that you will see time and time again.
Correct. All right. So now we'll move on to just a couple minutes about reporting. So we've talked about, you know, you get the opportunity to defer your capital gains. Again, I'll just note that it's just your capital gains. So this differs from a 1031 exchange and the deferral available there for the real estate space, in that you don't have to reinvest your basis. You can pull your capital gains off. So for those familiar with the compliance side of this, what you'll see here is a snip of a Form 8949, which is the form that individual taxpayers use to report their gains, or partnership taxpayers too, use to report their gains, their capital gains, to the IRS. And we simplified it and crammed it onto one form, and I'll talk you through over the next couple of minutes how this gets reported. But you can see here on the first line, we have a sale of Apple stock, where the proceeds were $460,000, the basis was $330,000, generating a gain of $130,000. So in the example, in this example, that $130,000 is all that needs to be reinvested within that 180-day period in order for that taxpayer to be able to defer the gain and get the 3 tax benefits that we talked about. They don't have to reinvest that $330,000 of basis. So now when we go to report this, for the sale of Apple stock, you're going to report it just like you would report any other sale. You're going to take a line on the 8949. You're going to show all the information there. What you're going to change now is that you have this code Z. And again, just for simplification, we put it on one slide here, but what you're going to do is you're going to do a separate line on this Form 8949. So you're going to report your 2 gains. It's the sale of Apple stock, and it's the sale of that property at Cecil B. Moore Avenue. You're going to report your 2 gains. You're going to add a separate line. That line in column A, you're going to show the EIN number of the opportunity fund that you invested in. So you actually have to tie to an opportunity fund with their EIN number in order to be able to report the deferral on your tax return. You're also in the date acquired column, which is B. You're going to put the date you invested in the opportunity fund. So what the IRS is going to do there is they're going to say, okay, with opportunity funds, it doesn't have to be cash for cash, right? You don't have to make the declaration when you sell your Apple stock that I'm going to reinvest my Apple stock gain in opportunity fund A. It's cash. You take the money, and then within the requisite period of time, you're going to fund this opportunity. You're going to fund this investment in an opportunity fund. So what the IRS is going to look at is they're going to say, okay, you sold Apple stock on X date. In our example, you sold it on 10/14/18. So you have 180 days from 10/14/18 to reinvest that gain into an opportunity fund. So then you're going to go to your line, you're going to put your EIN number, you're going to put a date that's presumably within 180 days of 10/14/18, and you're going to report. Now you're going to skip C, D, and E, and you're going to go to F. F is we're going to put code Z. Code Z, as it notes on the slide, that indicates you're reinvesting this in an opportunity fund. You're going to adjust the gain as a result. In the adjustment column, you're going to put a negative the amount of the gain that you invested. So in our case, if we had opportunity fund ABC, we'd add a line, we'd do a Z, a negative 130. That negative 130 would carry over to H, and what you would end up with is effectively a gain of 130 adjusted down by 130. You're going to report no gain. So that's the reporting on the individual side. That's going to tell you exactly how to now, I have to report the gain of the sale of my Apple stock because it's not a specific identification. And then I'm going to report that within the requisite time period, I made a qualifying investment into an opportunity fund. And therefore, I'm able to defer that much of my gain. If you do multiple investments in multiple opportunity funds, you would just show all the funds by their EIN number, the dates of those investments, the Z and the negative for each of the amounts that you invested. So it's not specifically saying my Apple stock went here and I don't report my Apple stock. You report all your gains, report all your reinvestments, and when they get to the bottom of the form, you're going to net them out to zero. And then as you can see on that form.
It's also worth mentioning.
Go ahead.
Sorry, go ahead.
I was going to say,
it's also worth
short-term form. There's long-term form, and you would just match up on the proper form which gains you're deferring.
Yeah, I was just going to mention that, a question that comes up often is, well, can I invest all the money I get back, including my original investment? And the answer is you can, but you're only going to be able to get these benefits, these QOZ benefits, for the actual capital gain, like Brian said at the front. It has to be the capital gain investment. So what happens in a case like that? Let's just say I had $500,000 of Apple stock. I forget what the gain number was, but let's just say it's $150,000. I take the whole 500. I want to put it into the investment. I really like this investment. What they're going to do is they will bifurcate the transaction between qualified investments and non-qualified investments. So your 150 will be in a group of qualified investments that are eligible for the benefits, and any other cash you put in that's not capital gain will just act and operate as any other investment in a partnership or corporation would, applying the normal tax laws. Simple as that. I haven't seen many people putting in non-qualifying gains, to be honest, with the one exception being where an owner who is putting in property sometimes and taking a piece of the action, and that's got limitations too, is putting non-qualifying property in.
Right. I think it's worth mentioning that, again, in Phil's example, 30% of that investment was a qualifying investment. The other 70%, which represented the basis in the stock, was a non-qualifying investment. So you have this mixed funds investment. It's worth mentioning because I get this question all the time. Well, can I still get the 10-year deferral? Can I still get the 10-year permanent exclusion on my basis, even though, you know, I don't need to take advantage of that first piece, right? That 2026 deferral, and it's very clear in the law that you need to take advantage of the temporary deferral till 2026 to be able to get the full benefit. It's only capital gains that are even eligible for this. So if you were to do what Phil proposed and invest all $500,000, and you were to sell after 10 years for $1.5 million, you would have to figure out, hey, 70% of this gain I have to pay tax on. The other 30 qualified under the Opportunity Zone program, and I don't have to pay tax on that 30% of my gain. So you're going to bifurcate it all the way up. It's rateable, proportionate, just like that. It is that simple, I guess, if you boil it down. It gets complicated when you start to add in liabilities and things like that, but ultimately that's how that works. Reporting at the QOF level. So now you have a partnership or a corporation that's going to self-certify to become a qualified opportunity fund. It has to use this form 8996 that you see on your screen. This is a form that it will file annually with its tax return. This form, you know, is going to indicate the type of taxpayer. You're going to put on there the first month in which you chose to be an opportunity fund. And then you're going to, as you can see on the form, you're going to test your assets. You know, I don't remember if we covered it yet, but we're going to cover it. There's 6-month and year-end testing dates that opportunity funds need to satisfy in order to remain not subject to penalty. So the self-certification is filed with the tax return. You have to indicate the first month you want to be an opportunity fund and make sure, just kind of anecdotally, and I think this might be covered a little later, you want to make sure you're an opportunity fund before you start to accept investments, because if you're an opportunity fund, you know, outside of that 180-day, if you declare your eligibility as an opportunity fund outside of that 180-day window for one of your investors, their investment in your opportunity fund would not qualify, and it would be a significant disadvantage to them. As it's indicated here.
I mean, that would be a. I'm sorry, I didn't mean to interrupt.
No, that's okay.
That would be a significant faux pas of the fund manager. But the good news is you're not filing the 8996 really until the following year. So if, God forbid, there are some investments that came in before they really intended to elect to be the fund, you have that flexibility to pick the month that the fund is deemed to be a fund. So in the example here, it shows, well, it might have been on the prior page, but if you form the fund or if you form the entity in January, you take some money, but you really were intending to elect in April, because you can elect all the way up till the end of the first testing period, which is the end of June, you're going to have to be sure that you don't make the election for a date after those funds came in, or you're going to have a problem. Now, gentlemen, I don't know in a circumstance like that whether it would be easy enough to correct that by returning the capital and effectively doing a mulligan, returning the capital and making sure that it goes in after the date on which everyone agrees it is going to elect to be treated as a fund. But you do have that flexibility of waiting until the following year.
Window. Yeah, I don't see a problem with returning. So those investors still have time within that 180-day period to be able to take the money back and put it back in again.
Yeah, you know, it shouldn't happen, but if I were an investor in a fund, I mean, the question I would ask is, when you're filing your 8996, when are you going to be electing to start that fund? And right. Presumably, if they know what they're doing, they're going to say, well, before we take your money.
Right, we did it.
And one other point is that, you know, this 90% investment test in qualified assets, qualified property, you have these two testing periods that are typically June 30th and December 31st. So if you form the fund before June 30th, that's going to be a testing period. If you form it in July, let's say, you're only going to have one testing period the first year. And the form provides for you to show the month that you're electing and whether you're going to have to fill out one testing period in year one and then or two. After year one, you're going to have two testing periods every year.
Yep.
Okay.
So I think that puts us to
next slide.
We covered.
Yeah, I think we covered that. Okay. Brian, you want me to take this, or you want to say a few things?
No, you can take this one. I think this, this talks about, if you want to take the overview, then we can kind of talk about anecdotally.
Sure. So you've got this 90% investment in qualified opportunity zone property that's required. Well, let's suppose you're the fund and you're just holding cash. Cash is not considered QOZ property. So if all you're doing is holding the invested funds in your in your QOF, you're going to flunk that test, which is problematic. There's a very simple solution to that if we go to the next slide.
There, we'll go back to the polling slide, and then we'll go back.
Okay, so the first exception, and this came out in the second round of regulations, is that you can actually hold the cash for 6 months in the qualified opportunity fund without a problem. It's still going to create some interesting discrepancies on the fund, which Brian can walk you through as to how those of us who are advising on these have resolved to deal with it. But it might upset the mathematicians in the audience, but we think it's the right conclusion. But the easy thing to do, you remember we talked at the outset about the reasons to have a qualified opportunity zone business, that second tier entity below the first one. Well, if all you do is take those funds, so funds come into my QOF, I create or already have in place my qualified opportunity zone business partnership or LLC. I set up my accounts, bank accounts for both. I take the cash from the fund and I put it into the business. And now I've got 31 months, what's called the working capital exception, to deploy that money. And there are some requirements that you spell out how you're going to deploy that money. It can't just be illusory. I mean, it's got to be a real plan. But what that means is that you can have cash sitting for a long time in the QOZB. So there's really no good reason that I can think of to have the cash sitting up in the parent entity, the QOF. I know of one example where a QOF was formed at the end of last year, and they didn't have time to get the funds transferred because of the last few days of the year. It took time to wire the funds into the QOZB. And there was some concern about how that would be treated going into 2019. And the regs came out and provided that 6-month exception. It kind of obviated the problem. But normally what you're going to want to do is get the funds in the parent entity, and that is going to in turn drop them down into the subsidiary entity. Okay, I think you can go to the poll question now.
Yeah, we'll do the question now. Ashley, are you there for the question? There we go.
Polling question number 2 on the screen is, how long can a QOF hold cash after a qualifying contribution without violating the 90% test?
Very good. I do appreciate it.
Make sure to get your votes in. This will help you get your CPE credit. In another few seconds, we have 85% vote.
Allison, I don't know if somebody doesn't have their phone on mute, but we're getting some background noise there.
All righty, and we're going to close it out. And the results are in.
Good answers. The correct answer is 6 months, so the 70% of you who voted that way are correct. Remember, the 31 months applies to the qualified opportunity zone business, that lower tier entity. So you're partially correct as long as the QOF drops that money down. If it's held in the QOF, 6 months is all you have. if it's dropped down again, you have those certain requirements to have a plan to actually expend that money. It's called working capital for a reason, because it's actually presumed that it's going to be spent according to a realistic plan that you have. You certainly cannot hold it indefinitely. Okay. We'll go to the next slide.
Yeah, I mean, just real quick, I guess anecdotally, as far as we talked briefly about, how to report or how to deal with that cash. Obviously, I went back to slide for the 8996. If the QOF is holding the cash at the end of the year, and I've seen this a few times now with dealing with 2018 returns, where a QOF was formed, the QOF received investments, late in the year that it's still holding in cash, and we're at 12/31. We have to file the tax return. There's still cash on the balance sheet, but we're within that 6-month safe harbor that was provided in the regulations. If you put in 0, if you exclude it from the numerator and the denominator, you get a formula that doesn't work because you can't divide by 0. So practically speaking, what we've done on the form is just throwing a $1 in as qualified opportunity zone assets, $1 in for qualified fund assets or total assets in the fund, and let that equal, show that there's no disqualifying assets in the fund with that $1. Because if you don't have, if that doesn't foot out and show that 100% of your assets are qualified assets, we don't talk about it today, but there's a penalty structure in place for funds who don't deploy at least 90% of their assets in qualified opportunity zone property. So just, as you're going through this, if there is cash, you are allowed under the regs to disregard it as an asset entirely. But if you disregard it as an asset entirely and it's your only asset, you're now dividing by 0, and the form gets a little bit weird to use. I think as we move forward now to timing issues for investors, we just want to remind you of the 180-day rule. You have 180 days from the date that stock or that asset is sold that generates the capital gain to invest. One thing we did get from the regulations that was unclear from the beginning is who is the taxpayer for purposes of qualified opportunity zones. I'll just do this quickly to compare and contrast to a Section 1031, because a lot of people seem to with this. But in a Section 1031, if you have a partnership that sells a piece of property, that partnership is the taxpayer for 1031 purposes, and that partnership has to make the election to reinvest the proceeds into an asset in order to get full deferral. One thing that the regs did provide with respect to gains realized by a partnership is that you have kind of 2 bites at the apple. The partnership itself can elect to reinvest the gain into an opportunity fund, and the partnership can become the partner in a qualified opportunity fund that then allows for deferral and the 2026 judgment day and the 10-year permanent exclusion at the partnership level. If, however, the partnership chooses not to, each of the partners, once they're allocated a share of that gain and they receive their K1, they are deemed to have that 180-day period from the last day of the partnership year. So it's almost 2 bites. If the partnership doesn't want to, this is really nice in the context where maybe you have 3 or 4 partners in a partnership, you're going to sell an asset, that asset's going to generate capital gain. They don't want to be partners afterwards. They don't want to do business together. I know I get these questions all the time from a 1031 perspective. Hey, 2 of us want to reinvest. The other guy wants his money and he wants to go home. With an opportunity zone, you can do that. You can just have the partnership not elect to defer the gain. You can allocate the gain to the partners, and 2 of those partners within 180 days of the year end can make a qualified investment into a fund and can defer their share of the capital gain, while the 3rd partner who wants to take his money can take his money, pay his tax, and just be finished with his investment. So that was a benefit we got in the regulations that clarified that and made it a little bit more flexible to use. Again, it has to be placed into a fund, and we talked about this briefly before. Qualifying investments must be in a QOF within 180 days. If that election falls outside of that 180-day window, you might have a problem. That's your example. We talked about the solution already, so we can move on from that.
Brian, I think we've covered the next few slides already. I would, especially given the time, suggest we jump to slide 24.
There we are, self-certification 24.
Okay, yeah. Now, the only point I want to make about this is as follows. There is a requirement that the fund certify its purpose, I'll keep it to that, a purpose of investing in QOZ property in a qualified opportunity zone business. The only importance of this, I would suggest to you, is that if you're using an existing partnership, or if you're using attorneys, for example, or professionals who are using template documents, they're not going to have the language in there that the rules technically require. This purposes and powers section example is from a partnership agreement that I drafted that specifically refers, probably a little redundantly, to the fact that we are meeting the requirements of investing in qualified opportunity zones. So the only thing I would caution you is, particularly if you are using a pre-existing business that you're going to anoint as a QOF, make sure that the agreement is amended to properly reflect the purposes and powers that are consistent with what the rules require. The other thing I might mention too is, if you're an investor, you want to be sure, since you're going into that, among other reasons, to get those long-term benefits, that the provisions in that agreement protect you to make sure that the managing members of the business, for example, don't decide, hey, we want to go out and sell this because that's how we're going to make our money. So you're going to want protections in that agreement to ensure that you're getting what you're paying for. Now, for the most part, well-run funds, this is going to be a non-issue, but don't ignore the partnership agreement and what it says for purposes of making sure that your rights are well-defined and legally defendable. Okay?
Great. So really quickly, just want to touch on the original basis, or how we calculate basis in a qualified opportunity fund. So your basis in your qualified opportunity investment starts at 0. If you're investing only capital gains on which you're electing to defer taxation, your basis is going to start at 0. Obviously, the regular general subchapter K partnership concepts apply to your investment in an opportunity zone, assuming that opportunity fund is organized as a partnership. So if the QOF takes on liabilities, your basis in the investment goes up by your rateable share of those liabilities as allocated under Section 752. Any income that's allocated to you, which is like under the normal subchapter K rules, your basis goes up for income, down for distributions, down for losses, up for contributions. But again, if you're making contributions of only qualified property, you're going to start out with 0 there. And then your basis is adjusted according to those 5 and 7 year, during the operation of the fund and during the temporary deferral period. You hit the 10-year or the 5-year hurdle that gets you 10%, your basis is adjusted by 10% of your original deferred amount. At 7 years, your basis is adjusted by 5 years, your original deferred amount. All of those are only important if you liquidate the fund investment, or when you go to calculate your gain on 2026. Obviously, as we talked about before, if you hold for that 10-year period, then the basis is deemed to be the fair market value of your interest in the QOF on liquidation. So you don't have to worry about your basis once you get past that. As it relates
Brian,
to
Phil,
let's also remember. Yeah.
Go ahead, Phil.
I was just going to say, it's also important to remember that if all you're doing is putting in cash and you're not borrowing money, because the issue of leveraging investments, as most real estate investments are, for example, has always been a big question mark with regard to qualified opportunity zones. Here, the use of debt will give rise to basis that can protect you from income by virtue of the partnerships taking depreciation deductions. Normally, it would be return of capital subject to the amount of your basis. But if you have a 0 basis and you haven't inflated that somehow, either by getting the 10 or 15% or borrowing money through the partnership and getting assigned your allocable share of that basis, then it is possible that you will have income from the depreciation, income will exceed the depreciation deductions, which would then be taxable.
Yep.
I just wanted to pose a question as well. As it relates to keeping track of basis, I know that's always a point of contention with practitioners. Could you guys speak a little bit to who is ultimately responsible for tracking the basis in these funds? Is the onus entirely on the investors, or will the funds have some responsibility in making sure that they're providing their investors with initial investment information some of these examples are pretty straightforward because they're for example purposes only, where you may have one or two investments, and that's for some investors, that's pretty easy to track. But if you start getting into many investments, some entrepreneurs don't do a very good job at maintaining books and records, and sometimes lack organization. Is there any onus on the fund side?
Obviously.
Go
ahead, Brian.
I always default to partners have responsibility for the basis of the partnership, and to the extent they need information from the partnership, they may have to request it. But that's where I always come out with it. Traditionally, that's what I see. The partners responsible for their basis.
The partnership should be able to calculate it, but as long as there's a delineation between qualifying funds and non-qualifying funds. And obviously, everyone gets a K1, which should reflect what the deductions are and what the income is. But I agree with Brian. It's ultimately the individual investor's responsibility, and one that they would want to certainly undertake to make sure that it's being calculated correctly for them.
Sure. Yeah. Well, I think the reason I bring this up is if you look at just a lot of the reporting requirements that are put on businesses these days, with 1099, obviously W-2 is kind of a given, but now some of the basis reporting for partnerships as well as S corps that we're seeing. Brian, I'm sure you between the two of us, we're dealing with this pretty heavily now, and also the reporting requirements for investment holding companies, investment houses, for a reporting basis to the investors. It just seems like this may be something that I wouldn't be surprised if at some point down the road they consider putting some of the onus on the funds.
Yeah, it's possible.
We'll see. Who knows?
I see we're hitting the 4 o'clock hour. I don't know how much time we have. I know we started a little late because I want to make sure we at least cover some ground. Can anyone tell me how much time we have left on this? Nobody?
Well, I think our time is pretty limited, but I think we can keep rolling just to kind of get through what we have to. Allison, I don't know if you're there.
Okay,
there is a time. I was going to say, I think there's a time where it's a hard cutoff where you can get your credit, but that doesn't necessarily mean that you need to hang up.
Hey guys, why don't we go ahead and do one of the polling questions? We still have a few of those left. I just want to make sure everyone gets their credit. So we have 2 polling questions left.
Yeah,
Let's go back to the third. We could go on that slide and I can launch that. Cool. Alrighty, so we're going to launch polling question number 3, and then after that we just have one more, so we'll launch that. And the question is, how soon after realizing a capital gain must an investor fund the money into a QOF? 31 months, 30 days, or 180 days? All right, we got 82 votes. Let's get up to 100 so you guys can get your CPE tonight. All righty, and we're going to close out.
We did. I'm trying to make it.
The results are in.
Right now, and then whatever difference.
Yeah. What do we have? I can't see them, I guess, because I'm
another winner.
So we have 180 days as the winner.
Yeah, that would be correct. That would be correct.
Okay, let's try to blaze through a few more slides. If we go to 24, I think it is.
We did
the slide is aware of the 707 disguised sales presumption.
That's
Sorry,
right. Slide 707.
27. Yeah. Okay. Just a quick word. I mean, this is mostly not going to be at the individual investor level. These decisions are going to be made at the fund level. But it's very common in a real estate investment to do a refi and use some of the appreciated value to make distributions to the investors. One just has to be aware of the rules with regard to disguised sales, which will essentially put the kibosh on the benefits of this and treat it as a transaction that we don't want. There's a presumption under the subchapter K of the partnership rules that distribution within 2 years is as a disguised sale. Beyond 2 years, it's not. So if there's talk about distributions within 2 years based upon leveraged financing, that's a good question to ask your partnership manager what the tax implications of that might be. It's a rebuttable presumption, but trust me, you don't want to get involved in a fight over whether you had a presumptive disguised sale or not. Okay.
Do you want to do the last polling question, or you want to?
Let's go ahead and do the last polling question. So this is polling question number 4. True or false, the initial basis of a qualified investment into a QOF is $0. And we have 78% votes. We also do, I'm noticing we have quite a few questions that have been streaming in. If the presenters can get to them during our session, they will answer. If you guys want to answer at the end, if we don't get to all of them, feel free to continue sending in those questions and we will reach out personally with an email on the answer.
Great.
All right, we have 84% votes. One more second, get your last minute votes in and get your CPE. And we're going to close it out. So it looks like true with 67%, and false came in with 33%.
Yeah, it is true. It starts at 0%, as we just discussed. It's adjusted under the subchapter K rules, and then obviously for those 5 and 7 year holding periods.
Okay, try to go through this really quickly. For me, if you go back to the question that was just in the, I think, previous slide, this has been the most vexing question in terms of getting a clear answer, because we all know in real estate transactions in particular, and I know QOZs are not exclusive to real estate, but that's been certainly the linchpin of the investments that I've seen. People use leverage to take advantage of being able to buy larger, more expensive properties. And the question that comes up over and over again is, well, do we get the benefit of the appreciation on that leverage? So I put in $100,000, I borrow $900,000, I buy for $1 million, it's $2 million. It's now gone up to $2 million. Do I get the benefit of the full $1 million appreciation? Of course, I have to pay back my debt. But the answer is, as best we can determine, and it's surprising, maybe it's one of those situations where the answer should be so obvious that that there has been no commentary on it. Before the second set of regulations came out, I did see some commentary from various professionals who suggested that it was uncertain. I think the correct answer is to go back to statute and say, because the statute says the basis of the property is the fair market value of the investment on the date it's sold, that the answer is you do get the benefit of the leverage. So if the property's gone up and the fact is you only put in a 20% or 10% of the equity, you get the benefit of that appreciation, which is a really big deal, because that means you're not relying solely on the capital invested. You're also relying on debt to leverage the transaction, make it a larger transaction, larger gains at the end that will be tax-free. Okay. The next item, very quickly, there are a number of people who want to manage a partnership and get carried interest or a profits interest in exchange for that. It's very common. Very quickly, it's not treated as a qualifying interest. That's treated instead as that so-called mixed fund. So it is ineligible for the types of benefits that we've been talking about. I guess that's all I'll say about that. Brian, you want to tackle the next one?
Yeah. So really quickly with the regs that came out in April, one of the big questions was, hey, look, 10 years is an awfully long time for some of these investments. Obviously, with real estate, maybe not as long of a time. Your hold periods tend to be a little bit longer. But if you're looking for startup businesses or other kind of businesses that may be, sprung inside opportunity zones, 10 years may be a really long hold. So there was some guidance that permitted a QOF fund to actually sell a qualified opportunity zone, to sell its qualified opportunity zone property, and to reinvest that gain or to reinvest their proceeds in a way that doesn't trigger, prematurely trigger the QOF investors' gain. So what you really wanted to avoid is, hey, do I have to do single asset funds that then hold for 10 years regardless? And the guidance came out and provided for this opportunity for a QOF to reinvest the sale proceeds. So if the QOF disposes of of opportunity zone property, it can then reinvest those proceeds within 12 months. There are some rules. They have to hold the proceeds in cash equivalents, or debt instruments with less than 18-month maturity. So you're really keeping it in cash. You have 12 months from the date of sale to reinvest the proceeds. In this case, you have to reinvest all the proceeds, not the capital gain. All the proceeds get reinvested into new qualified opportunity zone property. So if you have a tiered structure like we talked about, the way the regs read now, you need to actually sell the qualified opportunity zone business. So if you own partnership interest or you own stock, you have to sell the partnership interest or stock at the fund level in order for this to work. There's been some commentary about, hey, there should be parallel treatment for a lower tiered entity. The lower tiered entity can sell its property, allocate its gain up to the fund, and allow that, or move the proceeds up to the fund and allow that to be reinvested. But ultimately, the way it reads right now, it does require the fund to sell opportunity zone property, and that should allow for, once you get to 12 months, you should then be able to take advantage of that 31-month safe harbor working capital exception. So it does allow funds some time to sell an asset, to sell a qualified opportunity zone business if it makes sense, but then be able to reinvest it without triggering that 10-year, without ruining the 10-year hold period for the investor.
Okay, very quickly, because I know we're running short on time, and I hate to blow through this because it's a very common question, but there are many instances where a party wants to sell a piece of property that they are then going to try to take that gain that they attained from the sale and put it into the opportunity zone, that business that is building on that property. And the statute requires that the property, to qualify as QOZ business property, must be acquired by purchase. What does purchase mean? Basically, purchase excludes purchases from a quote-unquote related party. So if I sell a property and then I'm taking an interest in the partnership that's going to own that and develop that property, I'm a related party. So what's the solution? And that happens all the time, by the way. We get this question probably more than any other. If you go to the next slide, the solution is you have to limit the you have to limit the amount that the related party can own to no more than 20% of the investment. So that deal has to be structured on that basis. So if somebody is contributing a very valuable property and there's not that much additional money that needs to be raised and they want a bigger percentage interest, it's not going to work. So they have to be limited to 20%. That's all I'll say on that. I think we wanted to cover very briefly, Tom, you wanted to cover a couple of things with regard to the state treatment of this.
Sure. Thank you very much. I know we are running short on time, very short, in fact, so I will try to be as brief as possible. What I really want to stress is when we're talking about this legislation, everybody seems to focus on the federal rules and regulations, and which are pretty complicated, as I think you've heard over the past hour. Take that jurisdiction and you tack on another 50 or so jurisdictions, it just makes it all that much more complicated. So what I'd really like to do is just impress upon some of the issues that we're faced with and make sure that we're taking this into consideration during the decision-making process as to what to invest and where to invest it. So up on your screen right now is a spreadsheet that shows as of today or right around today, what states are conforming and what states are not conforming, and what states have no capital gains tax, which sort of makes this exercise somewhat of a moot point. If you look at, there's two different sections to this, to your left and to your right. One thing I want to make sure everybody's mindful of, this is an issue that happens very frequently in state taxation, is we don't necessarily know as taxpayers how we're taxed. Are we taxed as a corporation or are we taxed as an individual? So this analysis was done to provide you folks with some information as to be mindful of, which is, if you are taxed as a corporation, then you will fall under the corporate net income tax rules and regulations of that state. And the same thing applies to personal income tax piece. So partnerships, trusts, individuals, usually they all fall under personal income tax. So that's really what you need to concern yourself with if you are a partnership or a trust or an individual. You know, am I taxed this way, and am I eligible for the same benefits as I am for federal purposes under the circumstances? A couple things, again, just to be mindful of. You know, one of the things that I think really is interesting and worth impressing upon is how interested, sort of the floodgates open when this regulation was passed. And what you see now with a lot of these states is they're just welcoming these funds and the investors with open arms. I would say that's what most states are doing at this point. Some other states are kind of proceeding with caution. You know, they're more interested in directing, you know, the flow of investment. And then you have some states that are just at this point washing their hands. Won't be surprised though if by the end of this year you're going to see a few more of the non-conforming states start to conform. I think it's from what I observed, it's pretty unpopular to not be a state that's conforming. But what I find interesting about these types of entities, and really I want to focus more so on the funds, because I think by and large that's really what this webinar was about, more so a deeper dive into doing the investments and some of the policies and procedures and practical applications. You know, these funds, and I welcome Phil, your input, and Brian, yours as well, but you know, this is an interesting fund. It's sort of it's an interesting entity. It's sort of a hybrid entity, a hybrid fund. You know, you're not supposed to be taxed, but you're not supposed to be taxed by virtue of the fact that there's credits available. But if you don't necessarily conform and comply with all those rules and regulations, you could be taxed. So within these funds, you potentially have different tax postures. In addition to that, what these states are doing is they're just throwing a ton of credits to investors, operating companies that are going to be doing businesses within these tracts, within these given jurisdictions. So if you look at sort of an interesting sidebar on this isn't necessarily a credit where you've seen the jurisdiction say, hey, no double dipping on this. You know, if you're working within a specific jurisdiction, within a specific state, and there's multiple credits available within that jurisdiction, you're pretty much eligible for them. So if you look at something that's always been a very complicated area of state taxation, which is state tax credits in all 50 states, it really ups the ante on that. And it really makes, you know, the knowledge of the credits within the jurisdictions that you're investing in that much more critical. Just thinking about it out loud, you know, if you look at what you're doing here is you're talking about a tax law that's been passed, and really a main purpose of this tax law is the tax benefit that you're enabling that's hopefully going to drive some economic development. So really, tax is driving a big part of this, and I know that some people out there may disagree with the approach and say, well, you're going to make these investments either way. That may be the case, but that may not be the case. So I envision that what's going to happen here is these funds that are set up and these investors really need to make sure that they understand the rules and regulations within these different states and these different taxing jurisdictions to make sure that they're maximizing the benefits that are being passed through to the investors. If not, I think you may put yourself in a situation where, you're exposing yourself, to the investors because you're really not providing them with all the benefits that you should in an investment vehicle that's very, very tax driven. So just something that I wanted to note, considering there seems to be a major tax drive behind these investments and these funds that are being set up. And unfortunately, we're really low on time, but I think just one last thing that I would say is I think some of the complex issues that we're facing as it relates to this, tax credits as well as, funds that are going to be investing in multiple jurisdictions. I don't know what the majority of investments are going to look like at this point. You're probably going to have some single investments, but I have to imagine that you're probably going to have multiple asset funds that are looking to diversify. So they're going to be investing in multiple jurisdictions, some of which are going to be jurisdictions that are conforming. Some may be jurisdictions that are not conforming. So really understanding what the fund's filing requirements will be, I think is going to be very important. These states haven't really provided a lot of information as it relates to what the funds are required to do. So we're still sort of in the wild, wild west stage right now, but it wouldn't surprise me if at some point you start to look at these funds almost like investments in muni bonds where, you have percentages of these assets that are, in certain states versus other states so that the investors know how to report that on their individual income tax returns come sale time, come recognition of capital gain time. So just a few words of wisdom there and food for thought. I mean, I think really what I really want to drive home is that you really need some expertise in the state tax credit area if you plan on getting involved with some of these funds, which obviously everybody on this panel is more than happy to help out with in the event that there's any questions or concerns. So that's about it.
Is there time?
I think we're pretty close to
running out of time. Can I ask if there's time for any questions? Yeah, I don't know, Allison, is there time to answer any questions?
I think that we're a little behind on time. We ran a bit over, which is okay. So what I'm thinking we could do is anybody else who's still on, feel free to send in your questions our way, and then we'll just reach directly out to you and we'll respond to your question. So feel free to continue sending. But other than that, as long as you guys are done wrapping up, we can probably wrap up the webinar. What do you think?
Okay.
Alrighty, so thank you everybody for attending today. Please remember just to take one moment and complete the online survey. You'll also find that this PowerPoint is listed within your handout section of the webinar, so you can refer back to those. And again, just as another reminder, feel free to send any more questions, any questions that were not answered throughout the course of the webinar. We will reach out to you directly. And we thank you for tuning in. Have a great day.
Thank you all.
Thanks, everyone.